radio for a really great future. We're talking real money.
It's what we do. We just do it every week. We keep coming back for more. We are gluttons for punishment. Actually, we're gluttons for money. And not gluttons. That's not a good word. That makes it sound like we're greedy. We're just here to help. And we want to help you manage your money better. I'm Don McDonald. Tom Cock is back in a studio-ish room for a change. You want to say something or you're just waving?
I'm waving at my wife who's looking at me through the window.
I was going to say, dude, it's radio. You can't wave at the audience. He's waving at you.
Wait, smell that. Ready?
What am I?
No smell of Clorox or any other.
They can't smell either.
Okay, I'm sorry.
They're stuck with one thing only.
Idea.
They have to listen to you ramble on, but this time not about laundry.
That's true. The laundry room is back in its proper use.
Tom is in his little studio room with hopefully a high quality connection. We're hoping. We don't know for sure, but we're gonna wait and find out.
Working so far, right?
So if you want to call us and talk about things like laundry or money, Tom's still an expert on it. Just because he left the room doesn't mean he doesn't know laundry. Give us a call at 855-935-TALK, 855-935-8255. It's really easy. And then, if you don't get to hear yourself, you can listen back to the podcast next week during the week. Because we put it up as a podcast on Tuesday and Wednesday, like we do every other day practically. We put out a lot of podcasts. As a matter of fact, recently, I was thrilled to get to interview a couple of guys that I really admire, and that's David Booth and David Butler.
Yeah,
Dave Butler
pretty big guys in the whole finance thing.
Yeah, they're kind of big wigs at dimensional funds, and so I got to interview them, and I put that podcast up on Thursday. It's about a new movie that was talked about in the Wall Street Journal today that was made about dimensional funds, and so we wanted to tell you about the podcast.
Yeah, and so it's worth listening to because it's out there now, right? That podcast is already posted.
Yeah, I put it up on Thursday.
Yeah.
So, yeah.
And it's a great interview. I listened to it. I listened to it yesterday. I thought it was your appearance on Stacking Benjamins you're going to talk about, or my appearance on the behavioral divide. One of those.
The behavioral divide. Did we ever find out how many listens you got on the behavioral
Not very many. So,
divide?
okay. So the reason that we're bringing up your piece is because the smart people in finance are generally the people that get the headlines most of the time, right? Not like David Booth and David Butler. The other guys, the guys that run hedge funds, the guys that run big funds, they're the ones that get the attention because they're the ones acting like they know the future. They know something you don't know. There's a piece of information you could glean. And that's why it's fascinating when you read about a guy named Ray Dalio, who's known as one of the best hedge fund. Yeah. At Bridgewater, one of the best, apparently.
And that's not saying
you never really know. Well, you don't really know because you don't really know his returns. Yeah, it is a big secret. But he's been warning about the shock to coming to the U.S. economy. He compares it to the dot-com bubble, which those of you old enough to remember was not a fun time in 2000 and 2001. And then people say, so Ray, so do I sell my investments? Do I time the market? What do I do? Fascinating that Ray says his mantra of investing is 15 good, uncorrelated return streams. In other words, 15 different types of stocks or bonds or assets that don't all go up and down together.
And that kind of sort of sounds like what we do for our clients. We have a lot of different asset classes and the point is to try to get them to offset the volatility of each other, because that's really what kills most investors is volatility. The bouncing around that goes on with your portfolio. And if you have all your money in stocks, well, and the stock market goes down 30, 40, 50%, it feels bad. So that's why you have other things. But it's so interesting to hear it come from somebody who claims to have some secret formula when in fact they're saying, Just make sure you have asset classes that don't move in the same direction at exactly the same time. Is that the gist of it?
And by the way, back to Tune Out the Noise. Great film. You can now go to YouTube and just type in Tune Out the Noise. It's about 90 minutes, well worth your time to learn how real investing works.
855-935-TALK is our phone number. Give us a call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
The other exciting thing about today's episode is the fact that Tom has now moved into the new model military aircraft museum.
Thank you. I just counted. There's only 11 planes in here. My goal is to have 30. I've got them.
How many were in the old model?
I think that was like 40 plus. There were a lot there. Yeah, I had a lot more room. This is tiny. So
you're just going to have to make do. We need all our aircraft.
I'm expand the room.
Yeah, that's good. We're back in there. And by the way, I did check on your listens, your views. We're talking about YouTube. Podcasts on YouTube. Yeah, which we all think is silly. We all think, but we do it. We're doing it now, too, because somebody said you're going to get extra listeners. So we did it. Right. So here's the thing, though. Yours, the Behavioral Finance Podcast from Avantis.
How many?
89 views.
Okay. All right. All right. I'm hoping to crack 100.
Talking Real Money, published on the same day on YouTube.
Oh, okay.
Just
comparison.
YouTube.
Yeah.
26 views.
Okay. And remember, how many downloads do we get a day, roughly?
Oh, 7,000.
Yeah, I mean, so this is really small. Oh, by the way, I looked up Tune Out the Noise.
But wait.
You know how many people have watched that on YouTube?
Oh, it's like 3 million now.
That's exactly right. Look at you, broke the code. I interrupted you. Go ahead.
Yeah, no, I was going to say, though, but my appearance on Stacking Benjamins on Friday.
How's that doing?
91 views.
And that was just yesterday.
That was just yesterday. Yeah.
And it was good.
Give me 3 days. Give me 3 days. I'll be at 200.
You want to learn the real, you don't think you get the real Don McDonald on this show? You get him on that one. I tell you what, you were just like unhinged. It was great.
The topic was the worst investments of all time. Now give me a
which is such a long
topic
list.
Like that.
And you picked an annuity, which is not an investment either, by the way. I meant to call you about that.
It is. You put your money in, and
it's not called an investment by the government
because of I explained in the show why it wasn't.
I know. Okay, I'm just. But
the industry calls it an investment. Yeah. It's not regulated. It's not regulated by the securities
as an investment. Yeah.
Yeah,
I would have picked, by the way, just because we're discussing it, and I'm going to give you my opinion anyway. I would have picked a leveraged single stock exchange traded fund. I think those are just the worst, absolute, horrible, idiotic, dumb stuff of all time.
Yeah, but you know what makes them nothing to it's kind of like saying the 3,000th meme coin is a terrible investment. I mean,
yeah, you're right.
Like,
okay,
12 people use them. Nobody really uses those things.
Okay, we can talk more about that. There's a lot of people using
let's use the
silly stuff.
Tesla's pretty famous, right?
Yeah, it is.
So Tesla have a 3X fund? I think they do.
Probably. I wouldn't be surprised.
All right,
Did you give the phone number too? We should probably do that because the show really is about you. Yeah.
935-TALK. I did give that. Okay. I have a Tesla 2X.
Oh, only 2X. Okay.
Only 2X long daily ETF with an expense ratio of 1%.
Oh, that makes sense.
Going long one stock and borrowing money.
Okay. A lot of work to be done there.
You cannot tell me that this belongs in the same category as annuities with $275 million in assets.
Okay. Is that all it has?
That's all it has.
Well, it's 275 more than it should have. Yeah.
Exactly.
But still, you're right. You're right. Okay.
All right.
And those darn annuities, every year they're setting a new record. Every year that's a higher number. Drives me crazy.
It's because there are about 10 billion young insurance salespeople out there who just got out of school and their first job as a financial advisor was for a life insurance company selling annuities. Let's see what are the annuity sales in the U.S. these days? 2024.
I think it's at an all-time record last year.
2024. Golly. This is why I named them. $432 billion.
Not
Almost
equity index annuities. This is all annuities.
All annuities. Almost $500 billion.
It's disgusting.
This is so sad because these, for the most part, are investments that are only for special situations that rarely make sense. Index-linked annuity sales are 65 billion in 2024 for indexed annuities.
Okay, then that's only like 15% or something, though. Yeah,
it's still because most annuities, I would guess, are immediate, maybe variable.
Where you give them the money, they start giving it back to you, and they give it to you for a period of time.
Yeah, it must be immediates because variables are also 60 some odd million. So it must be the immediates.
Million or billion?
Billion, I meant to say.
Okay.
Yeah. Wow.
None of this is good. These aren't things you should use.
Anyway, I want to go back to Ray. I want to go back to Ray Dalio for a minute and his advice for a recession, because you would have thought that he had some fancy strategy, but in essence he says, if you want to simplify it, bottom line, own stocks and bonds.
Diversify.
At its simplest form, that's what he's talking about. Invest stocks and bonds because they tend to offset each other. But here's the bit of advice that I think should resonate with everybody who's ever thought about investing, because you do fear a downturn in the market. It is our big fear. This is a quote from this article on Investopedia. It says, Dalio's approach to market crashes centers on preparation rather than prediction. That is probably our biggest message on this show and has been the whole time. You want to get it right. You want to have the right portfolio. You want to not panic in a down market. Then you need to build it right to begin with.
For me, it's just putting it all in international large value stocks that are up 12.5% this year. You just put it all in there.
Yeah, because Tom is so good at predicting the future.
I'm prescient. Yeah. International small cap value up 11.4%. Just put it all there.
Look at his first marriage. I'll tell you that he's not good at predicting the future.
I'm not a good predictor of many things. So, that is really great advice from Ray. Now, I wonder if he follows that, what I thought when he invests in his fund. I kind of thought, it doesn't sound like a hedge fund to me, but okay.
But maybe it is, because when you think about it, he's saying using 15 different uncorrelated asset classes, or they call them return streams, but really it means asset classes because they're talking about bonds of various types, by the way.
Yep.
The income streams can vary within, like long-term bonds are a return stream, while intermediate-term bonds are another return stream. So they got a lot of these return streams that are the same asset class. But basically the bulk of the portfolio, a well-diversified portfolio, according to Ray Dalio, should be bonds, stocks. Now, I think he's too aggressive because he suggests a very large portion of your money in long-term bonds, which we think are highly risky because they're volatile. We're trying to eliminate volatility. And he also wants you to have some money, not a lot, in gold and commodities.
Yeah, I saw you added gold and commodities in there. I mean, the thing that I really liked from it was he had many stock asset classes. It's not just the S&P 500. There's small companies there. There's value companies. There's international. There's emerging markets. All of those things that I was being facetious when I said move all your money to international small cap value. That's a risky asset class. You should hold some of it. And what he's really saying is, have a little bit in all those places. You better do that ahead of time instead of reacting to something that just happens or may happen.
Because what we do is we react and we make wholesale changes in reaction to things that have already occurred, and we're wagging the dog with our tail.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Because it's a really big part of your real life. We want to help you manage money better, and you can get answers to your questions and try to find some guidance by having a conversation with us when we're on the radio every Saturday on Northwest News Radio in Seattle at 855-935-TALK, 855-935-8255. 888-866-7855. We talk about the two major components to diversification, the two major components. Some will argue for minor components. Okay, that's fine, but let's stick with the big ones, and that's stocks and bonds. We spend an awful lot of time talking about stocks, not as much talking about bonds because they're not nearly as sexy. But there are a couple of ways to own fixed income in your portfolio, be they bonds or CDs. They're very similar. They pay a stated rate of interest for a stated period of time. And if you hold them to maturity and the bonds don't default or the bank doesn't go belly up, then you will get your money back at the end of the term, every penny you put in if you bought it when it was issued. Now, all bets are off if you bought it after it was issued and or you sell it before it matures, because then the price fluctuates depending on current interest rates. But if you hold them all the way to the end, then you do reasonably well. You're not going to get rich because right now, high-quality bond yields are in the 4-ish range. That's about all you can expect. However, and you can buy a bond fund, and in a way, a bond fund is like a bond ladder. They're always buying new bonds. The bonds are maturing out of the portfolio and sending money back to the portfolio to reinvest. And then they're taking that money and reinvesting it at whatever the prevailing interest rate is. So you're going to have an interest rate, depending on the maturity of the bond fund, that's pretty darn close to your, whatever the current bond yield is. If it's a longer term fund, there'll be a bigger difference. Shorter term, closer. But there's another way to do this, and one that I kind of like. But the problem is it's hard to do, and that's to create a ladder. A ladder buys bonds or CDs. It's more typically done with CDs that mature over a period of time. Generally, 5 years is a good number. They mature one at a time over that period of time. But there are also you can ladder bonds. A lot of people ladder bonds: 1 year bond, 2 year, 3 year, 4 year, 5 year. But now there are actual mutual funds, our ETFs, that do it for you, that create a bond ladder.
Yeah,
it's sort
fascinating.
And it's not something that we talk about a lot, but it's another interesting way to hedge against bond fluctuation, which is what we want to do.
iShares, iBonds, 2025 term corporate. I looked it up, IBDQ. Now, this is one that does ladder. But I mean, I got to ask you, because you spend more time on fixed income than I do. When you buy a bond fund, like, for example, just a generic BND, they do own some short term, some intermediate term, and a tiny bit of long term. I mean, it's kind of laddering of a week, right?
Well, that's what I was getting at. I was saying it is a form of laddering, but it's not a strict laddering. However, here's a laddered bond fund, while it's kind of cool. In fact, I'm looking at the iShares Core U.S. Aggregate Bond ETF, which is AGG. Its portfolios are very, very high quality. It's almost all investment grade or better. Most of them AA, because most of them are governments. Which, by the way, our government is a AA government, not a AAA government.
Don't go there. Yeah.
There are corporations with higher investment ratings than the United States. Isn't that sad?
I'm just going to let that one hang. Sure.
I just think that's really sad. But anyway, so I'm looking at this one. They ladder out to about 10 years, 2034, 2035. So you got a lot of these different maturities. But here's the same problem with these that exists with bond funds. And that is the fact that in 2022, the laddered fund still lost 13%. So it's really no different than owning the bond fund in the end.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
All right, this will mean nothing to you podcast listeners, but for somehow I'm very jealous because Northwest News Radio found the traffic announcing guy, the guy who announces the traffic, who has a much deeper voice than even mine.
Wow.
Did you hear his voice?
I hadn't even noticed.
Like,
I'll listen more carefully.
Now, traffic on the 4th. I'm going,
wow.
I'm not that low. How'd you get lower than me?
How can you go that low? Okay.
How can you go that low? He's way down there. That's a register. All right. Welcome back to the show. I'm Don. That's Tom. We still have, like, all of our lines are open. Is it nice weather there today?
It's kind of partly cloudy. I wouldn't call it nice.
It's not raining,
it's not pouring either. Probably somewhere in the greater Puget Sound area it is, but at this moment in beautiful Duval, Washington, no, it's not. Not, thank goodness.
Thanks for not helping. 855-935-TALK is our phone number. That's 855-935-8255. We prefer questions from you live during the show, but we have a backup because we get people who go to talkingrealmoney.com and then they send in questions and we answer them on the show, but that makes Tom read them because he is the question hog, and he never lets me see them until, like, the minute he reads them. These are all fresh to me. I don't get any help going into these questions.
I thought it's
kind of like real radio, like live radio. What?
Exactly. Like, because this comes from Tampa, Florida. I thought maybe you would know because it's
hour and a half down the road in good traffic. But given the fact that section of road between Disney and just past Disney is the most congested road in America now.
Wow.
It takes hours. It can take hours to get to Tampa.
All right, well, stay here because I've got the question from Brian. You don't have to go anywhere.
I don't have to go there.
No, he says, I heard a question on a recent podcast episode about bond funds to choose in a taxable account. I think your guidance was based on a few factors, but mainly federal tax bracket. If I'm in the 35% bracket, should I only hold muni bonds in my taxable brokerage?
Yeah.
I'm 40 years old. My current bond holdings in taxable brokerage are 10% of the portfolio, all in FX, NAX. I think that's Fidelity's total bond. Hold zero bonds in my array of tax advantage accounts, 401k, IRA, HSA, etc. Given my age and risk profile, I try to keep bond holdings limited. But for the 10% I hold in a brokerage, should I move the entire allocation to a large low fee muni bond fund like MUB or VTEB instead of my current bond index fund, FXNAX? Looks like I'd gain a slight edge on net realized return that way. Yeah, I think you would at 35% tax bracket. Sure.
Well, wait. Let me just tell you how big here's the thing. How does Fidelity? I sometimes just wonder about Fidelity. I do. And this is just me musing. But the Fidelity, that FXNAX fund, has a current yield of about 3.37%.
I don't know.
Why so low?
By the BND has about 1% more than that. I think that's like 4.7.
I know. And here's the thing. FTEB from Vanguard, the Vanguard tax exempt bond ETF, has a 3.56 federally tax-free yield. The 12-month yield, which is probably more comparable, is 3.12. But man, in your bracket, you are going to be at 4 point something effective. So
yeah, you're going to want that one. That's weird though. The Fidelity's, their muni index is the same as their taxable.
No, that's Vanguard's muni. I don't know about Fidelity's.
You said FTEB, so I thought it was
no.
Fidelity product. VTBE is Vanguard's total muni bond.
Yes, VTEB.
Correct. Okay.
Yeah,
that does not make sense though. That Fidelity's total bond is so low.
And the effective duration of the Fidelity is 6 years.
Yeah.
The duration of the Vanguard is 7 years, so it's a little longer duration. That would account for some of the higher yield. Credit quality is comparable. Wow. Yeah, I'd go tax-free anyway, just because you're in effectively the highest bracket.
Okay, but there's an easier fix.
What?
He mentioned it himself. I hold zero bonds in my array of tax-advantaged accounts, 401k, IRA, HSA.
Yeah.
Why won't you just hold the bonds there and then make the after-tax brokerage account all stocks?
Yeah.
Easier, I think.
I don't know. Not when the VTEB is earning more than the Fidelity. I'd do that right now anyway. 855-935-TALK. Call us.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
You know, Tom's been slaving and sweating over his studio to get it all ready for your visit today. He's been hoping you'd stop by, and yet, as of 45 minutes into the program, you have yet to show up. So it's kind of making him sad.
Yeah, real sad. I wish I hadn't gotten all this trouble. I should have just stayed in bed.
You should have just stayed in the laundry room. Should have just stayed in the damn laundry room.
I like the smell here better, so much better.
The smell of model airplane glue.
Yeah, I love that glue, you know. So
love that glue. 855-935-TALK is the phone number here, 855-935-8255. Answering questions is what we like to do the most.
Yeah,
but
you know,
to answer them, we need you to ask them. What?
Yeah. So we don't have any callers?
Well, let me look again.
Okay.
No,
so
we still don't. From 12
I have a comment I can make here. I have something I could say. Actually.
Oh, I'm going to let Tom speak for a while. Go ahead.
Well, it's fascinating because I chatted with a gentleman last fall. We did a portfolio review. We looked at his portfolio, and it had some pretty big holes in it. It was very centered in large U.S. companies. Very centered. This would not surprise you. Had most of its money in large U.S. companies, a lot in growth, all the names you know. And I told him at the time, look, you should fix this. And then he went on a long trip, I think it was, or something. I wrote him. And I said, you know, you don't want any help? You want to talk about it again? He finally wrote me back and he said, well, yeah, I thank you for following up. And I went ahead and sold about a third of the stocks, and my money's in the money market.
Because I'm waiting for the right time to get in. Is that right? You know, was that it?
Something like that. Like this is.
I'll get in after the market goes down some.
My fear is too many of you believe that's what investing is. It's a response to something. This happened, or it's going to happen. I got to do something with my money.
Not as much even a response as supposedly the anticipation of something. The belief that a future event is somehow predictable or follows in a logical fashion, that the thinking that a down market follows an up market, which is true, but it doesn't do it in a predictable fashion.
Yeah.
There's no pattern, in other words.
You can go back and look at some of the biggest, sharpest downturns of the last 20 years, and if you missed a few of the days on the other side, or got in too late by a month or something, you missed most of the increase. So you really don't want to be a market timer. You don't want to be somebody who responds to, as you correctly pointed out, Don, what could happen. And that's why we started the program talking about Ray Dalio, who is a very well-known, among the best-known hedge fund managers, who you would think would tell you, here's what the future looks like and here's why you got to change, or here's what I think the bad. And he said, yeah, it could be bad. It could be like .com again, blah, 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 but be proper allocation is really what he had to say at the end of the day.
Yep. And what is the effect? I love this statement. And this is a fact, by the way. If you miss the best days, you really miss a lot. Really miss a lot. If you had missed the 10 best days in the stock market over the past 30 years, which has been a great 30 years for stocks.
Indeed it has, yes.
And now think about, in that 30-year time frame, we had the .com bust.
Yep.
We had the 08 bust. We had the COVID bust. We had all of these happen, and yet it's been one of the best periods for stock returns in history. If you missed the 10 best days, you just happened to get out and, that was the best day. I missed it. Darn it. Okay, I'll get it. I'll catch it next time.
10 in 30 years? Is that what you're saying?
30 years.
Wow.
What is that? 30 years times 365. Let's get 10,000 days. She missed 10 out of 10,000 days.
And
your return would have been cut in half.
That's just incredible.
In half. And by the way, some of those worst days, those best days, occurred in 2008, for example. There were a number of the best days that occurred in 2008 when nobody wanted to be in the stock market. You just missed those. And if you look at a chart of the markets going back, well, let's just go back to when the S&P 500 started in the 50s. You'll find that the vast majority of that scale is moving higher, only in very brief periods of time. And usually these periods, at least since the 50s, these have been periods of no more than about a year, maybe a little bit over in the dot-com bust. But they're not long. 2008 was about a year.
Yeah.
The 2022.
Well, 2020 went straight down and turned around, went straight back up. 2022 was pretty close to a year, correct?
Was almost a year, yeah. But when you look at them, they're really not long-term, or at least they haven't been for most of our lives, baby boomers' lives.
Yes. Mm-hmm.
So you're betting against the house when you're betting that this is the time to stay out and I'll get back in later.
Yeah, and we find very few people make the bet correctly on both sides. So, yeah, I think that's great advice. Proper allocation, proper risk balance. Get on with your life.
See, I made them all feel guilty. Now they're calling. Let's go to Seattle. William, welcome to Talking Real Money.
Hello.
Hey, William. Thanks for calling. What's up?
I got two questions. The first is I'm 71 years old, and Fidelity is now requiring from me to take a required minimum distribution from my 401k, even though I'm not 73.
What year were you born?
53.
Yeah, it doesn't make any sense.
Well, they're requiring it before they allow me to take any more withdrawals.
What was that last part? Requiring you and
before you can take anything
the required minimum distribution before they allow me to take any other money out.
That sounds wrong.
That just doesn't make sense.
Because they now start in the year you turn 73.
Correct. And you could do it any time in that year.
Yeah, that's for all of us who are under, except unless we were born after 1960. Was it 60?
1960. You can wait till age 75. Correct. But otherwise,
I would call somebody else at Fidelity.
Okay, but wait. So is this through your retirement plan at work?
Yeah, it's my 401k.
I'll bet the administrator, somebody there in that staff, has that number wrong, because you could see it then. Because Fidelity, I'd be very surprised, but the people that run the plan may not be as well informed. That's possible. But no, you're fine until age 73, as Don said.
And that law applies to every retirement plan.
Yeah, well, they didn't care what I had to say. They just said, well, it's what the plan is, and we're required to do that before we allow you to take any other money. And
are you still a participant in the plan? Active?
I am working, but I do contracts on the side. And
okay, so you're not contributing to this anymore. Why not move it to an IRA with another custodian and just eliminate the problem? Because if they're, again, without any more information, I don't know. But hang on for a minute. We'll get to your second question after we take a really, really quick break. Don't go away. 855-935-TALK is our phone number.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
He said, I went and did some looking on Fidelity's own websites, and they have a little note that says some employer workplace plans may operate differently and send RMDs in accordance with their plan rules.
That could be the only thing that could be. That's very odd. But then, as you said, alleviate that by moving it to an IRA and tell them bye-bye.
If you just move Just move it into an IRA, and that takes care of that problem. What's your other question? Because we only have a couple of minutes.
Okay. I'm still working. I do contracts on the side, and I have my LLC based at my father's house in Florida. And the firm I'm currently working for is based in Florida. Area is in Boston, so I have to go to Boston every once in a while. But this means I make a lot of money, and I'm not required to do anything for capital gains for Washington State, which I have all my stocks and bonds and everything in my plan in my LLC. Am I going to run into a legal issue by keeping it there in Florida?
Don't know. Yeah, it's a good question.
Yeah, honestly,
I see what you're saying.
Because if it was, I am not familiar enough with the Washington capital gains tax rules on where securities are domiciled.
Yeah, you get a large exemption.
Yeah, what is the
anyway,
exemption? So anyway, you're a Washingtonian.
I forget. It's like $250,000. It's some large number.
Yeah,
that's gains too. So
this is one of those questions that you want to put to a Washington accountant or tax attorney, not just a general one either. You need somebody who knows the Washington capital gains law. It doesn't sound like you would be, but I don't want to give any kind of legal advice that could get you in trouble.
We don't know.
Because I just don't know enough about it. Thanks so much for the call, though. We really appreciate it. The rest of you, please hang on until the next hour. We'll get you in then, because this hour is almost gone.
Yeah, I do want to mention, speaking of almost gone, I have one spot still left to meet with somebody in beautiful Scottsdale, technically Arizona, coming up on Monday, the 14th of April.
Technically, it's definitely Arizona.
Well, no, I was going to say Phoenix, but it is technically Scottsdale, which we're going to meet. So, love to do it. We do a review of your portfolio. We sit down and chat about your situation. It's free. There's no obligation. And I've got one more. So if you go to talkingrealmoney.com and click on Meet an Advisor and just say, Meet with Tom in the Desert. So please fill that last spot.
Say it anyway. You could even say, Meet with Tom in what is technically Arizona.
Okay. Somewhere in Arizona.
He's using you. He's using you guys to get a tax write-off. I know what he's doing.
I'm not going to write it off.
Yeah, he's trying to. Yeah, it's business trip. Yeah. Oh, were we lounging by the pool? Oh, well,
there was that.
That was an added benefit. But
that tequila, that's very expensive. That should be written off. So sure.
Yeah. Particularly at the hotels you stay at. Hey, if you want to ask us questions, you can call us during the show every Saturday, 855-935-TALK, or you can send your questions in by going to our website, which, strangely enough, is the same name as the show. Talking Real Money, just with a .com at the end. And send us your questions. You can either speak them in there, which is very good for me because it makes my Friday show so much easier, or you can type them and then they go into Tom's secret stash somewhere. Either way, it's really easy to do. Just go to talkingrealmoney.com and look for that button in the upper right corner that says Contact Us.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.